This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Hey, Jason, just wanted to send you a quick message of gratitude. I'm so grateful that I got into the game and got in with properties that make sense because the rent income keeps coming in. So thank you. Glad we connected, and I'm glad to be in the income property game instead of the Wall Street game for my future.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1949. We're almost at that 10th episode show. And Friday, we will have a 10th episode show and a Flashback Friday all at once. That's a bit of a rare occurrence, so stay tuned for that on Friday. So today we have Rick Sharga with us again, and he had some awesome insights on our last episode. You know that if you listened to it, if you heard it, if you saw it on YouTube. So it is there for you. If you didn't catch it, go back and review that after listening to this one. But let's look at some interesting data. Why do I want to look at this today? Well, because, during the Great Recession, you might recall that we heard a lot about something called shadow inventory. And for the last few years, I've talked a lot about something called shadow demand, housing demand, shadow housing demand. And we heard during the pandemic that a lot of adult children were living at home with their parents. In fact, we heard about that long before it. In fact, there's a movie about it. It's called Failure to Launch. And it is an interesting time for sure. Now, if you are seeing this on video, I am showing two charts that show COVID-19 disruptions associated with a large increase in share of young adults living with parents. This is the percentage of 18 to 29-year-olds living with a parent. And in 2019, that got as high as 47%. So can you imagine if you're a young person, right, and you're 18 to 29 years old, and you're, for example, thinking, well, I'm in the dating market because I'd like to find a significant other. I'd like to possibly get married and start building a life with somebody. Well, that person you're dating, if it's not you, that person you're dating or want to date is probably living at home with their parents. I mean, makes things a bit awkward, doesn't it? Because in 2020, this number went up. It increased by 5 points on up to 52%. So more than half of all 18 to 29-year-olds were living with a parent. Now, I don't know about you folks, but for the parents out there, hopefully you love your children, and that's all great, but isn't it kind of cramping your style a little bit to have them living with you when they're full-grown adults and they should be out on their own, making their way in the world? It's a new world, folks. And frankly, you listening, and maybe some of you personally are the ones, or somebody who is much older than that, living at home with their parents. I know people who are 39 years old or in their early 40s living at home. Now, these people, sometimes they're sort of slackers and they're just not willing to they've kind of got that failure to launch syndrome. But others are actual responsible adults. They're winners. They've got a good career going. They're making money, maybe not even a fortune, but they're making enough to certainly have their own place. But they don't want to, because they want to just travel all the time and have avocado toast. So they're not moving out. They're going to impose on their parents and live with them so they don't have to pay a house payment, home insurance, and all the other stuff. So yeah, it's quite something, folks. But what does this mean? What does this mean, and where is the opportunity for us as investors? Well, if you didn't figure it out already, and I talked about this during COVID, this is not a totally new subject, but if you didn't figure it out already, this implies, well, not only implies, it is hardcore evidence of shadow demand, because eventually, at some point, these kids have got to leave the nest. They have got to grow up and get out on their own. And they're going to need a place to rent, maybe the place you bought through jasonhartman.com, or they're going to need a place to buy, and it might be the place you bought at jasonhartman.com. And either way, that's going to be good for you, because imagine you got this huge population of people, 18 to 29 years old, and more than half of them are living at home. And they're going to get out on their own, and they're going to need a place to rent or a place to buy. So it's going to push rents upward, and it's going to push sales prices upwards in the face of everything. Remember, these people are going to need entry-level housing. They're not going to want to buy the stuff builders are building today that's $500,000, $600,000, $700,000. They're going to want to buy an inexpensive entry-level bread and butter house. Well, they may not want to buy it, but it's the only thing they can afford, okay? And that's good for you. Or they're going to rent it from you. And either way, if you're selling your property or if you're renting it, good for you. This is great news for investors. A lot of shadow demand that has yet to hit the market. Now, I do want to give you a word of caution, though, because this will not always be this way. Of course, these people will move out and form their own households, and that's good. We talked about that. But what else? Down the road, and I've got a show coming up on this with a very interesting guest. Now, he was more bearish on it than I was, but we do have a population decline. Yes, I said decline problem, where we're going to see reduced housing demand, but not to worry too much, because that's quite a ways away. I figure we're going to be about 20 years away from that. My guest that I interviewed, and the show will be published soon, he thinks that is coming sooner than I do. He thinks really it's about 10 years away. But either way, you're going to take a nice ride and make quite a bit of money with your income properties if you do it right before then. But just know that the world is shifting. There is definitely a shift, and there will ultimately, in the future, probably 20, 25 years into the future, if you ask me, we will see a bit of a decline in housing demand. But again, nothing to worry about today. You got quite a ways before that happens. But the great thing about demographics, what I really love about studying demographics, and I've studied them really since the 90s, is it's very predictable. I mean, you know that if someone is born today, just do the simple math. In 20 years, well, they're going to be 20, right? You can't change that. That is a sure thing. And you know that if they're 25, they're going to be moving into their household formation years. So that means housing demand. But it is changing, so it's not going to last forever. Just want you to know that. That's my word of caution for you, my disclaimer for you. Okay, be sure to get your tickets. This is probably the final time I'll say this, because I just got the count, and it looks like we do have to call Empowered Investor Live sold out as of the end of the week, probably. This is a little fuzzy because we have various event affiliates and sponsors that are bringing staff, and We're trying to get a handle on the numbers of staff they're bringing. They get a certain number of tickets along with their sponsorship of the event and so forth. So it's always a little bit fuzzy, right? But anyway, get your tickets for Empowered Investor Live. Go to jasonhartman.com or directly to empoweredinvestor.com/live and grab your tickets. And we look forward to seeing you there. It's going to be such a great event. We're so excited about it. And then also our upcoming cruise. This is just about 1.5 months away. So it's like 6 weeks away, our cruise. And that's going to be a great cruise in the Caribbean, empoweredinvestor.com/cruise. We have all balcony staterooms, so no cheap, crappy rooms for our attendees. And again, this is a small group event. At last check, I think we've got about 8 rooms left. I've got to talk to our cruise planner, our travel agent on that. She'll give me the exact number. But be sure to grab your tickets, get signed up for the cruise today if you want to join us for that. All balcony ocean view staterooms. It's going to be a great time. We're going to go to Miami. We're going to go to Costa Maya and Cozumel. And if you like to snorkel or scuba dive, it's going to be phenomenal for that. But if you like to invest, remember it includes a one-on-one coaching session at sea with yours truly. And probably your investment counselor, because we're going to have the investment counselors there too, I think. Haven't got RSVPs from all of them yet, but the cruise is going to be a fantastic event too. Small group, just kind of vacation, talking about investing and what's next, what's in the future, what are your plans for your portfolio and how to make it all work better. empoweredinvestor.com/cruise for those tickets and empoweredinvestor.com/live for the Scottsdale conference. All right, let's get to our continuing interview with Rick Sharga, who is here to give us some more insights onto the future of the real estate market. So here we go.
At least I'm banking on for next year is let's assume mortgage rates have peaked for this cycle and the Fed can stop being quite so aggressive. That will give the financial markets a chance to kind of stabilize and mortgage rates to gradually go down over the course of 2023 to where we get down into the fives. Yep. You know, if that's the case, and if home prices, as we'll see in a moment, appear to be plateauing and wage growth continues to be strong, I can give you a scenario where the market feels a whole lot more affordable toward the second half of next year than it's feeling in the second half of this year.
Okay. Good.
But those rates have had a very definite impact on home sales. Existing home sales are off 13 consecutive months. We were actually seeing a little bit of a weakening of demand at the end of 2021 as prices continued to soar. And we've rarely seen a cycle like we've seen in 2022, where every month home sales have been lower than the month before. We completely wiped out the normal seasonality in the spring and summer months where home sales go up. And that you can tie directly into the increased costs due to mortgage rates. New home sales, and you and I were talking a little bit about this, they're a little bit more volatile, a little bit more sensitive. And when we've seen interest rates tick down a little bit, we've seen a spike in new home purchases. But still, we haven't had a single month. We've had only 1 month this year where new home sales exceeded the prior year, and year to date, we're down about 14%. So the likelihood, Jason, is we end this year overall down somewhere between 15 and 20% from 2021 numbers.
In terms of sales volume.
Sales volume. And you keep making a good point. 2021 was also not a normal year. 2021 was a very strong year in terms of the volume of home sales. So we're going to be down. We're going to be down a little bit from 2019, which is the last pre-pandemic year, but still, trending in not a particularly favorable direction.
Just want to point out again, everybody, Rick is talking about sales volume. Not sales prices.
Yep, and we will talk about prices. One of the things we've been fighting is lack of inventory. That's true in both the existing home market and the new home market. Builder sentiment, which is the blue line here, it's a survey that's done among new home builders, has dropped almost as far down as it was at the worst of the pandemic. It's not quite approaching Great Recession pessimism, but it's pretty weak. And the dotted line on this chart is single family home starts. And after starting the year pretty strong, they've been dropping in double digits for the last 4 months. So the builders got the memo this time. They saw that people were slowing down with their purchasing. And so they slowed down on the housing starts. So that will keep new home inventory from getting terribly robust next year.
And again, for those who are silly enough to try and compare this to the 2008 Great Recession, there is one of your ingredients that shows that, I mean, we're coming into this economic era with a shortage of housing.
Yes.
Okay. Back then, they came in with an oversupply of housing. So it's just a completely different thing.
People keep forgetting that, Jason. I'm glad you brought that up. Even though we've seen inventory appear to get a little better lately, and that's not because of new listings. That's because it's simply taking a little longer for properties that are listed to sell. We're looking at about a 3-month inventory. In a normal, healthy market, you're looking at about a 6-month supply. Leading into the Great Recession in 2008, we peaked at about a 13-month supply of homes for sale, which is twice as much as the market can usually absorb. And at precisely that point in time, we had about 15 million really bad adjustable rate loans resetting.
Yeah.
And resetting at rates that the owners simply couldn't afford to pay. So they all had to sell their homes into an oversaturated market. It was a perfect storm.
Right.
We're looking at very little new supply. In fact, new listings are 28% lower than they were a year ago. And this is from Altos Research, and they track this every week. So very little in the way of supply. That's one of the reasons that I agree with you, Jason. We're not expecting home prices to plummet, because there's simply not enough inventory on the market to encourage people to lower the price of their homes. And we have very few people who feel like they have to sell. So inventory outlook is that maybe by the end of year 2023, based on current rate of sales, we might get back to prior cycles worth of inventory, but we're not going to be back at that 6-month supply anytime soon. This is probably interesting too. We saw a couple of years in a row where list price reductions on properties were lower than normal, and that was because we had limited supply, we had strong demand. It was accelerated by those historically low mortgage rates, which, as you mentioned, were kind of an historical aberration. But people didn't really need to lower the list price of their homes. Yep. And in a normal year, about a third of all list prices are reduced. So we went from a period where fewer than normal property had list prices reductions to where that number is higher than normal. And there's a seasonality to this too. You typically see more list price reductions at the end of the year. Yeah. We believe, Altos believes that list price reductions have probably peaked, which is an indicator that new listings are coming to market more realistically priced than listings from, say, 4 or 5 months ago, where people were still expecting
Rick,
to get last year's
I mean,
sales.
Mike Simonson with Altos has been on the show a couple of times, and I love their data. I quote it all the time. But this data, this particular chart, is not very meaningful for me. And maybe I'm wrong, but I spent 19 years in the resale market, right? The traditional residential market there in Orange County. And the problem is every seller, when they think of the value of their home, they're always looking in the rearview mirror. Mm-hmm. And when you get to an era like this, where we've been on this extremely hot market, like just never before seen, right? Of course their expectations are just way too high. Yep. And so this seems to be like more of a little bit of a soft metric to me. I love the inventory data they produce, but this one, I don't know, the price reduction thing, I don't quote this a lot because to me, it just, I don't know.
I like it because I believe it's indicative of the market correcting. And I look at it as people bringing to the market properties that were overpriced versus people bringing properties to market that are more realistically priced. So I think we've seen that trend happen where people aren't looking a year in the rearview mirror anymore, Jason. Maybe they're looking at somewhat more recent numbers, but there's so much data that I'm not going to get stuck on this one and
I got you. Just wanted to point that out. Yep.
No, and the other two things, and this is an interesting one, and I think the next chart is interesting. We are seeing a weakening in demand, and that's indicative of what we're seeing in pending sales, which typically show you what we're going to see in closed sales over the next couple of months, and we're seeing again fewer pending sales, and that's been a month-over-month decline for quite some time now. And we're also seeing it in the number of purchase loan applications. And this is from the Mortgage Bankers Association. This is a little bit of an eye chart. But if you follow the yellow line, we actually started the year stronger than most prior years. And by the end of this year, we're down 41% compared to where we were a year ago, but are also significantly below where we were even going back to 2019. So
folks, listen, if you want to give to charity, the Starving Mortgage Brokers Association could use it because, they made so much money in the refinance business. Literally the whole country refinanced maybe a couple of times in the past couple of years. But I mean, it's just plummeted. It's off a cliff, the mortgage business.
And this is just purchase loans. If I showed you the chart on refinance, the drop off
that's even worse. Yeah.
The drop off is about 86%. We have other charts than that I didn't bring along today, but this just again, it's an indicator that demand is weakening, and that's I believe a short.
Rick, before you go on, I want to just comment on that because you are so right with what you just said. Sometimes declining demand is a result of, look, people just don't want it. They already have it. Their needs are satisfied in the marketplace. A lot of this is true with like consumer electronics. If you look at Apple, for example, how do we get people to buy a new phone? They don't need a new phone. We got to invent some new feature that'll get them to buy it, right? But in the housing market, there is so much demand psychologically and like necessity wise with household formation. People want to buy houses in a huge way. They just have been priced out with the massive, historical, unbelievable increase in interest rates. They're just priced out. Yep. So what do? They've got to stay in the rental market, right? And so you've seen some data lately, and I'm sure you've kept up with it, Rick, that rental prices have now finally decelerated, right? Because they were going up like crazy too, just like housing prices. Yep. But that's misleading. Because number one, it surveys mostly institutional apartment complexes, not single family rentals.
Right.
Okay. Very misleading there. But also, look, it's just a lot of things are just taking a breather for this short little spot in history. And everybody's trying to make a big deal out of it and project it into the future for 3 years. And you just can't do that, especially given the seasonality issue as well. But
yeah, we've seen single family rental prices hold up better than what we're seeing in the multifamily market. So
multifamily's overbuilt. Yeah.
It in some markets is, and this chart actually gets to part of this discussion. It really depends on your local market, and so you do see those rent prices varying depending on where you are in the country, pretty significantly, and also by price tier. So the national data suggests that in the multifamily market, you're seeing a little bit more of a decline in prices at the high end, which shows that people are looking for more affordable apartments when they're looking for apartments. But we're seeing the same thing and by the way, again, your point could not be more right. We've seen industry surveys that suggest between 10 and 20% of people who plan to buy a house have decided not to at this point, at least temporarily, because they can't afford it. I would suggest that is a definite prospective boon, at least short term, for single family rental owners, because if somebody was looking to buy a house, maybe they're more interested in renting a house than renting an apartment. So something to keep in mind.
They'd much rather be in a single family home than an apartment.
Especially people with growing families. You mentioned earlier how localized this particular cycle is, and I thought this chart from Freddie Mac was particularly educational that way. This, I believe, is going to be a hugely localized market correction. I'm expecting home prices to go down by maybe 5% nationally by the end of next year. And look at what we're seeing in this chart. You're seeing price declines up and down the West Coast. You're seeing it in some of the the boom towns from last year when the work from home movement had people, moving to Boise, Idaho, and St. George's, Utah. You see those markets in decline. You see the Denver market in decline, Austin, Phoenix, Las Vegas. But look at the Southeast, look at the Midwest, and you're seeing prices actually continue to increase in the Carolinas, in Florida, in Tennessee, and some other markets. So I do believe we're going to see a very localized correction across the country next year. And yes, if you're in a market like Boise where prices went up 45%, you're likely to see more than a 5% price decline as the market sort of resets. If you're in Charlotte, or if you're in Raleigh, or if you're in Nashville, you may see prices continue to go up as population grows and as jobs continue to grow. So it's going to be a very localized correction, and everybody is basically seeing the same sort of thing. This is a chart from Zillow for looking at the coming year. And again, whether you like Zillow's estimates or don't like Zillow's estimates, and I know the real estate market is kind of split on that.
Yeah.
They're calling out a lot of the same trends and a lot of the same markets that Freddie Mac was, and some other forecasts are, again, some of the markets that kind of overheated, likely to claw back a little bit more. And some of the markets experiencing population growth will continue to be strong.
Yeah. So Rick, just to comment on that, we divided up into three types of markets in the country: linear markets, cyclical markets, and hybrid markets. And the cyclical markets, they're always the high-flying markets in every boom and bust. Well, yeah, they have glorious highs and really ugly lows. They fluctuate a lot more. But most of the country is a linear market. It's just boring, okay? And, you say localized, but I say the big declines are going to be limited to the cyclical markets that have run up too high and need to readjust. They need to come back to earth. They've just been crazy. So, but the problem is, though, the way the media covers that story makes everybody think it's the whole country. And if you look at the Case-Shiller Composite Index, it's got 20 markets, and 15 of those, literally 75% of the markets they're covering, are cyclical markets.
That's
only
a great
5%.
point.
It's so weighted towards cyclical, and it just doesn't cover hybrid. So it's so frustrating.
Or linear. Or, I mean, every time I do a presentation to a group, Jason, I want to have an asterisk at the end that says local results may vary.
And that's a good way to put it.
And I agree with you. I was talking to Lawrence Young, who's the chief economist for the National Association of Realtors. And Lawrence had a great point. He said, if you're in Phoenix and home prices have gone up 50% in the last 2 years, if they go down 10%, is it really that big a deal?
You can give some back. Yeah. It's only a big deal if you were the last buyer that bought at the very peak of that Phoenix market.
And even then, if your time horizon isn't Tuesday, you're going to be okay.
Yeah.
Because I desperately need a life and need more hobbies. One day I researched home prices over the last 100 years across the country. And in all those years, there's been one period where home prices have dropped 20%, and that's stuck. And that was during the Great Recession back in 2008. And we all have PTSD. So everybody thinks because it happened once, it's going to happen again. It's never happened before. And hasn't happened since. And over time...
Well, it must have happened during the Great Depression, though, in the 30s.
Well, it might have, but again, it didn't stick. And keep in mind, home ownership back in those days was far, far lower than it is in today's market.
Oh, interesting.
Home ownership rates nationally were probably only about 35 to 40%, because financing wasn't available. It wasn't really until 30-year fixed rate loans were allowed back in the late 50s that you saw.
It all changed in 1938, folks. That's when the GSEs came about, FHA, and that changed the whole market. And that's what made the United States a very special real estate market. Investors, very different from every other country on earth. So good points.
And there's still massive equity out there, which again is another $29 trillion, according to Freddie Mac. Our data at ATTOM says that almost 50% of people with a mortgage are equity rich, which means that they owe less than half of the value of their house. They have a $400,000 house and a $200,000 mortgage. Mm-hmm. So this cushion is also one of the things that leads us to believe we will not see a huge increase in foreclosure activity, because if you have positive equity, and I mentioned earlier, 93% of people in foreclosure have positive equity, you have ways to get into a soft landing, sell your house at a profit, perhaps even refi if you were short-term out of work but now have a new job. And just a couple of quick slides on foreclosures, because I know your audience is interested.
Yeah, before you go into this, yeah. And I want to talk about the 10 people in the country that are in foreclosure. there's only 10 of them. Just kidding. But I mean, the numbers are, I think you're going to say really low, yes, but we'll see. But 93% of the people in foreclosure have positive equity.
Yes.
They're not underwater. Is that
right.
what you said?
Yes.
The foreclosure process takes time, folks. So a notice of default was filed. That's what you're calling in foreclosure, right? That means they've defaulted. But still, there are many months, and in some places years, before it's actually going to turn into a change of ownership. And during that time, they're going to do a workout, a loan modification, a short sale. Well, they don't need a short sale because they have positive equity. They're right. Just going to put the house on the market and sell it and get a little bit of money out of it, maybe not as much as they wanted, but yeah, it's just and
we're actually already seeing that in the numbers. People, again, coming out of 2008, tend to believe that if you're in foreclosure, you're underwater on your loan.
It's not the same. Yeah.
No, you're in foreclosure because you lost your job. You took an income hit. You had a divorce, death in the family, unexpected bills that turned you upside down financially, and so you can't make your mortgage payments.
Or hey, don't forget to mention like the millions and millions of people back in the Great Recession in 2008 who just did strategic defaults. They had money, they could have paid their mortgages, they just chose not to.
We're not seeing much of that this time.
Fair enough.
I think we did last time because so many people were underwater.
Right.
If suddenly you found yourself 30% upside down on a loan, you did ask yourself.
You're like, yeah, I'll walk away. Yeah.
But let me put this in context for you, Jason, because I think this is an important point. Our data shows that about 6% of homeowners nationally are underwater on their loans. There's 0.5% of homeowners who are in foreclosure. So that means that the overwhelming majority of borrowers who are underwater on their loans are still making their mortgage payments on time. And I believe in many cases they're doing that because A, they can see a light at the end of the tunnel and they're almost neutral or almost going to be able to be right side. Or B, it's cheaper for them to keep making that mortgage payment than it would be for them to go try and rent something. So it's actually, kind of a strategic non-default decision, if you will.
That's an interesting point. Yeah. I think you're right.
To your point, the predictor of foreclosures is mortgage delinquencies. And according to the mortgage bankers, we're actually below pre-pandemic levels of delinquency rates. There was a big fear when the pandemic hit and the government put a forbearance program in place that everybody who took up the government on that forbearance, being able to stop making mortgage payments for a period of time, which wound up being almost 2 years for a lot of people, those people were going to go into foreclosure. And 8.3 million borrowers took advantage of that program. There's about 300,000 left. It wouldn't be that high, except some people who were affected by the hurricane in Florida opted to get into that program temporarily. But of the 8.3 million people, less than 0.5% have defaulted on their loan after going through that program. It's just been one of the most remarkably successful programs we've ever seen. So that's why we saw delinquencies spike, because people were in that program. Particularly the green bar you're looking at here, which is 90 days plus delinquencies. But now in a normal year, you look at delinquencies, it's typically about 4% of loans that are delinquent but not in foreclosure. There's another 1% that's in foreclosure. We're down to 3.64% of all loans being delinquent. And if you look at early delinquencies, those 30-day delinquencies, almost the lowest levels the MBA has ever tracked since they started collecting this data back in the 1970s. So the loan quality has just been extraordinary, due in part to
the underwriting standards have been obnoxious.
They have been, and the rules that the CFPB put in place after the financial crisis have kind of kept lenders coloring within the lines.
Yeah, oh my gosh. I mean, it's like that's an overcorrection. I mean, it's been so hard to get a mortgage that no wonder the loan quality is so good. I mean, it's good and bad. I mean, I think they've overcorrected, like I say, but last time
I don't disagree with you a bit. I think there was some
way too
overcorrection.
loose. Yeah.
But and I'm fearful now that you mentioned earlier, mortgage volumes are dropping. I'm a little bit concerned that we're going to see some lenders go back to Wild West days, and start giving loans to anybody who can fog a mirror, which also wouldn't be the right approach.
That's there's a happy medium balance, folks. There's balance. Yeah, that's what we need.
You mentioned 10 people in foreclosure. It's slightly more than that, but in a
11 people.
Yeah. So this is foreclosure starts. This is the initial notice of foreclosure, and we track at ATTOM. Foreclosure starts, we track properties scheduled for a foreclosure sale, which is the next stage, and then we track repossessions by the lender. The numbers tell kind of an interesting story. So you can see how far foreclosure starts dropped after the government put its moratorium in place and put the forbearance program in place. I mentioned in a normal market, we're about 1% of loans in foreclosure. We dropped to about 0.2% at the nadir of this cycle. We're now back up to about somewhere between 0.5 and 0.6% of loans being in foreclosure. But again, to give you some rough numbers, normally with 55 million active mortgages, we'd have about 550,000 loans in foreclosure. Today, we have about 260,000, 270,000. So we're roughly half of where we would normally be.
Okay. So when you say normal on foreclosures, Rick,
yes.
Is that just sort of at any given time, like
yes.
through all economic cycles, about 550,000 homes are in foreclosure just in any given time?
Almost. Historically, if you look at the averages, about 1% of mortgages are in foreclosure at any given time.
1%. Okay. And now we've got 0.5%.
Yes.
Right.
And so the 550 number is relative to the fact that we have 55 million mortgages active today.
Right.
So if you have more mortgages, that number rises. You get the idea.
Sure, of course.
What's interesting here is that foreclosure starts, just that first notice, are back up to about 80% of where they were in 2019. The subsequent stages of foreclosures are nowhere near where they were back in 2019.
Right. Yeah.
And that's an indicator to me that what you and I were talking about earlier is actually what's happening. That people are getting that first notice of foreclosure, and rather than waiting for the foreclosure auction and losing their home and losing their equity, they're putting the property on the market and selling it, and probably selling it at a profit. And that's nowhere more obvious than if you look at repossessions, which have not come back to anywhere near pre-pandemic levels.
This is unbelievable. Folks, this chart, if you're not watching this on video, this chart is mind-blowing. It basically shows you foreclosures that actually finish the process and turn into an REO, I mean real estate owned by the lender, by the bank, right? So this is a finished foreclosure. And there's like nothing. I mean, It's just nothing. It's inconsequential. This is the 10 people I was talking about earlier.
And all kidding aside, Fannie Mae usually has the biggest portfolio of REO homes.
Right.
I spoke with somebody there a couple of weeks ago, and they have 1,200 across the country.
That's it?
That's it. And
in a country this size, boy, if you're in the foreclosure business, you're starving.
you are. And so here's, for your investor audience, this is probably the most important thing I'm going to say in our conversation today. If you're going to play in the foreclosure space, you need to change your mindset and your approach and do a 180 from where you were in prior cycles. This cycle, you're going to need to find the homeowner in the early stage of foreclosure and negotiate a deal with that homeowner. If you wait for the bank to repossess the property, you're going to be waiting a long time for a very little bit amount of inventory.
Yeah.
The other thing we're seeing, Jason, is that the properties that don't sell prior to the foreclosure sale, but they get to that auction, the sell-through rate at the auction right now at the courthouse or the sheriff's sale is about 70%. Prior to the pandemic, that was about 30 to 35%. So there's less homes getting to the auction, and a higher percentage of homes getting to auction are selling to third-party investors. So there's just nothing left to go back to the lenders. And so if you're going to be playing in this space, you either need to be at the auction or you need to be working directly with that distressed homeowner earlier in the cycle, or you're not going to be able to find a foreclosure asset.
Yeah, so if you're an investor and you make money by getting foreclosure properties, you got to be working the pre-foreclosure market and the NOD market, meaning notice of default, like right when it's filed, you got to be negotiating with that homeowner to try and buy it because they're not getting to the end of the cycle. Hardly any of them get there. Yeah, good. Well, that's bodes really well for the real estate market. All of the stuff you said. I mean, Housing Wire likes to call them the crash bros.
Yeah, I get a kick out of that.
And Logan's been on the show several times. He writes those articles about the crash bros, and the crash bros have just been wrong, and I think they're going to continue to be wrong. So,
well, and you and I were talking about prices earlier, and again, one of the reasons we don't believe there will be a huge drop off in prices is if you have a lot of REO inventory, they typically are sold at discount prices, which becomes one of the comps in your neighborhood and can have an impact on local market pricing. With no inventory out there that's distressed, you're just not seeing that have its impact, taking its toll on prices. So again, very different market cycle than we've been in prior years, and people need to be looking for sources where they can find those homeowners who were in delinquency and distress earlier in the cycle this time, and learn to knock on doors and send out postcards and do that sort of thing.
Yeah. All right, Rick, is that it, or do you have anything else to show us?
Gosh, if that's not enough, I don't know what is. That's plenty of slides for one day, I think, Jason.
That was a very, very good overview. I mean, a lot going on. We love the data you share. There's just so much of it. And we appreciate you coming back on the show. Anything you want to wrap it up with? Of course, give out your website or any resources you want to share with people.
Yeah, a couple things. We publish this information for free on the website. No subscription, no anything. It's ATTOM data with 2 T's, ATTOM data.com. Go to the insights section on the website and you'll see new reports up literally every week. You can follow us on Facebook, Twitter, LinkedIn. You can also follow me on LinkedIn and Twitter if you like. It's just Rick Sharga. I make it easy for everybody to find me. If you want to connect with me on LinkedIn, mention that you heard me with Jason so that I know you're not some crazy person from China looking to hack my account, because I get a few of those. But the other thing I'd point out, and shameless plug here, ATTOM does have a product for individual investors called ATTOM List. And if you're looking to find a list of distressed homeowners in early stages of foreclosures, you can develop a marketing list. It's a self-service product online. So there are other good resources out there as well. But again, I'd encourage your listeners looking for those distressed assets to think upstream this cycle. Don't wait for the banks to repossess, because you're not going to find the inventory you want.
Good stuff, Rick. Well, thank you so much for joining us. We always appreciate having you back, and we'll look forward to talking with you in the future.
Do it again sometime soon, Jason. Take care.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.